Welcome to Taking Stock for the week ending the 29th of April 2022. Where joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jason, and hope you had a great long weekend early in the week.
I've had a great weekend, and thanks for having me again, Kien. It's probably a good time to have a quick disclaimer. The information provided today is of a general nature and therefore should not be considered personal advice. Any tables and charts we share is based on historical data and therefore should not be relied upon as a guide for future performance.
Yes, Jace, thanks for that. So just make sure you conduct your own research on any ideas we present today. Well, it's been another week of market volatility. And once again, inflation and the prospect of interest rate hikes have driven fears around market valuations, especially across the growth sectors of the market, which are thought to be more sensitive to interest rate movements because of their larger cash flows into the future. And Australia's headline inflation during the week, it surged to 5.1% in the first 3 months of the year. And that's above expectations of 4.6%. And now many economists are anticipating that an interest rate rise could occur as soon as next week.
So we've displayed this on screen right now, which compares the RBA's cash rate expectations, which is shown in black, compared to the market's expectations, which is shown in red. As you can see, the RBA has revised its cash target upwards from 1.5% to around 2.25% by 2023. However, the market is anticipating a sharper lift in interest rates to around 3.5% within the next 2 years. The rise in interest rates could potentially dampen consumer spending and lift the cost of debt and potentially lead to lower equity valuations. However, at an absolute level, rates remain low compared to historical means, and a high household savings ratio could cushion higher debt servicing costs. It's also important to keep in mind that rate hikes don't necessarily hurt everyone equally. In fact, they can help certain sectors like financial stocks. So if you're in the business of lending money, higher rates mean higher margins.
Yes, Jace, but at the moment, due to their sensitivity to interest rate movements, growth stocks have borne the brunt of the market volatility. In the US, the NASDAQ, it's fallen to its lowest level in a year. While here in Australia, our growth stocks have also been under pressure, including star stocks like WiseTech, IDP Education, Infomedia, Hansen, Netwealth, REA Group, and those healthcare stocks like CSL and ResMed. And even though earnings both in the US and Australia are holding up well, there are deepening concerns regarding the economic outlook stemming primarily from the ongoing Ukraine and Russia conflict and China's COVID zero policy, which has also impacted resource stocks this week. So the question, Jace, is should growth and quality investors be concerned right now?
I think the short answer is don't panic. Remember that we're trying to compound our wealth over the long term, and dealing with market volatility is part and parcel of investing. Some investors might tend to favor more stable companies like large caps during times of market volatility. And this is probably why our star income stocks have fared much better in the current environment compared to our growth portfolios. Remember that a stock's price is a function of its future earnings. So look for companies that have a competitive advantage that are likely to generate strong cash flows across the various market cycles.
It's also interesting, Jace, with the chart on screen, which compares the MSCI Australia Growth Index to its forward earnings trend. As you can see, despite the volatility across growth stocks as represented by the blue line, forecast earnings among the growth stocks have continued to rise. More often than not, these incidences, it creates this exceptional opportunity for the prudent investor, because from history, we understand that this style of investing has led to strong market outperformance. So with that in mind, let's now turn our attention to some of our star stock highlights for this week. And among the companies to release its update was supermarket operator Coles Group. Its supermarket division, which makes up most of the group's performance at around 88%, reported a lift in comparable sales of around 4% over the third quarter, which was towards the top end of analyst expectations.
Yeah, this was a pretty solid update considering the fact the company was affected by a lift in COVID costs and also disruption from the floods in South Australia, New South Wales, and Queensland. Now, although Coles was able to contain inflationary pressures for now, The company plans to protect its net profit margins by continuing to push its home brands, which account for 31% of the supermarket sales. Earnings revisions have also been positive because as COVID cases fall, customers are actually going back to malls where Coles has a stronger presence than its competitor Woolworths. So the sales momentum should help support free cash flow, which remains well above dividend distributions. The company is trading on a gross dividend yield of around 4.8%.
Yeah, and also its dividend yield is higher than of Woolworths' gross dividend yield of around 3.3%. And the reason for this is due to its lower earnings growth profile, with Woolworths maintaining its lead on grocery and fresh food market share. So something to keep in mind.
On the topic of income stocks, we recently initiated coverage on the Bank of Queensland, which is expected to go ex-dividend on the 4th of May. At the current prices, the stock is trading on a forecast gross dividend yield of around 8%. Now, I do realize that the share price was sold down quite heavily post its interim result. What was the story behind this move, Kien?
Well, Jace, the reason for the sell down was because the bank reported a 12 basis point decline in its net interest margin to 1.74%. And this is the spread between the bank's borrowing and lending costs, which was below market expectations. Being a regional bank and with a lower credit rating than the majors, Bank of Queensland is more reliant on higher cost funding sources such as bonds. And coupled with intense competition on its loans, this has led to pressure on its net interest margins.
But despite the pressure on its net interest margins, we don't believe the dividend is at risk because the bank generates strong cash earnings that is above its expected dividend payment. And this has led to an unstretched dividend payout ratio of around 61%. So moving forward, the bank should benefit from synergies from its recently acquired ME Bank acquisition and also rising interest rates. In terms of the corporate calendar, ResMed has actually announced its third quarter result today. Revenues and earnings came in below market expectations and refer to an analyst commentary for more information on that company. Looking ahead, well, it's the start of bank reporting season, Kien, with ANZ set to kick off its results on the 4th of May. This will be followed by NAB and Macquarie Group on the 5th and the 6th of May. Meanwhile, quarterlies from Independence Group should come out tonight after market, and Woolworths is also anticipated to release its quarterly results next month. As discussed earlier, the Bank of Queensland will go ex-dividend on the 4th of May.
Thanks, Jason. Over to our technical alerts. ANZ, they triggered bullish trend change on the SD Max, which is the stock doctor moving average crossover, and that is suitable for investors that are highly trend sensitive. Here at Lincoln, our cornerstone philosophy is about investing in financially healthy businesses to build long-term wealth. So this week we present an interesting case study with EML Payments. They are a platform that offers digital gift cards as well as banking and credit facilities to businesses and retail customers.
The company's share price declined by 38% earlier this week after it cut its annual earnings guidance by around 14%, which was due to operational issues in Europe. Now, the European segment is EML's largest revenue generator, contributing to more than 60% of revenues.
Yes, Jace, but it's distressed financial health that alerted our members that an investment in this company is highly speculative, as represented by its share price trend over the year. In fact, if we look at the share price over the last 5 years, we see a textbook pattern play out. Initially, investors are rewarded on the back of the hype and hysteria, only to find out over time that the risk of loss is high as the financial risks begin to emerge. And drilling into the financial health, the company reported a 477% increase in earnings, but operating cash flows were negative over the last interim result. Furthermore, while the company does have a high level of borrowings, its balance sheet is plagued with an elevated amount of liabilities, which is in the form of stored credit for gift card holders. And this has resulted in a marginal total liabilities to total tangible assets ratio.
Yeah, this is quite interesting, Kien. And also the collapse in share price might perk the interest of some value investors, especially since it is now trading at a steep discount to its valuation. However, following a failed private equity takeover early this month, a high level of short interest at 9%, distressed financial health, and recent earnings downgrade, we just feel there's better and safer opportunities elsewhere.
And now, following on from our case study with EML Payments, a prudent question this week is how do investors distinguish between an investment opportunity compared to a value trap? Firstly, a value trap is a stock that looks cheap, but there may be a good reason for it, and it could become cheaper later on once earnings downgrades are announced. So a value trap tends to have high elevated active risk that could potentially derail the earnings and dividends outlook.
Yeah, so if a stock's share price has declined quite significantly, the best way to determine whether it is an opportunity or a value trap is to actually look under the hood and see where the heightened active risks lie. This could be in the form of weak financial health, a change in its structural operations or business model, which may have led to recent bad news or earnings downgrades. To monitor the news, you can refer to the announcements page, which also provides you with a history of its share price reactions to help investors decipher whether the announcement was good or bad for the share price trend.
That's right, Jason. And you can also assess the earnings trend of the stock by referring to our earnings revision factor under Golden Rule 3, or by looking at the earnings trend under Golden Rule 4. In this section, you can also look at the level of short interest to understand whether fund manager sentiment on the stock is negative. And also under Golden Rule 7, see whether the directors have been selling their stake over the year. So, share price value on the back of weak financial health and poor earnings revisions, rising short interest, and or director sell down suggests that this stock is more likely a value trap.
On the other hand, opportunities tend to present themselves on the back of share price volatility if it's driven by systematic or macroeconomic events. A prime example of this is the inflation and interest rate thematic that has caused the market to capitulate. In this instance, quality and growth stocks are sold down indiscriminately, even though earnings have held up quite well. So once again, you can confirm the earnings trend by referring to our earnings revision factor under Golden Rule 3, or by looking at the earnings trend under Golden Rule 4.
But sometimes, Jace, it's not easy because there may be limited visibility in the data. For example, a company may have no consensus forecasts. In this case, you'll need to conduct thorough due diligence, refer to the recent announcements, look at the financials such as earnings quality metrics, and perhaps call the analyst for a chat if you need to. Okay, that's all we have time for today, but thanks again, Jace, for your insights.
Pleasure was all mine, Kien.
And also, don't forget to tune into our Lincoln Live webinar this Monday, where our Chief Investment Officer, Tim Lincoln, Senior Portfolio Manager, Matty Swartz, and of course, our Stock Doctor tech expert, Rob Manfrey, and myself help answer your questions on stocks, market strategy, and utilizing the Stock Doctor platform. So the key takeaway from our video today is the macroeconomic fears driven by inflation and interest rate hikes has caused significant volatility across the quality growth and resource stocks. But use Stock Doctor to help you identify those opportunities, especially among those with strong earnings updates, unless, of course, you are a trend-sensitive investor. In the meantime, take care and have a happy, healthy, and prosperous week, everyone.